So we're on to the chapter 11 on markets and agriculture, an introduction that we're going through right now. And the previous chapter described how rural and urban sectors interact in the process of development. The goal of the next few chapters is to look closely at the markets and institutions that form the rural sector and deeply influence the lives of individuals who live in developing countries. In particular, we will study the markets for land, labor, credit, and insurance. We're going to study all these three uh, uh, in the later parts of this course that followed this particular introduction. Although we emphasize rural markets, at several points the discussion will apply equally well to informal markets in the urban sector. The study of rural organization is interesting from another perspective. Throughout this book, we stress the importance of information, incentives, and the existence of limits to contracts. These three features acquire importance in the context of missing or imperfect markets. So that the importance of information, incentive, and the existence of limits to contracts. Importance in the context of missing or imperfect markets, where the markets are missing or they are imperfect, which is the essential ingredient that complicates real economies, right? Because there's perfect competition in the markets, and the information is usually not missing, and the markets are usually not missing. So, these are the three features that we will study about. If all markets were perfect, we would only have to study supply and demand carefully and be done with it. Okay. An essential property of imperfect markets is that they are contagious. A market feature in some sector can lead to problems in the other markets. The markets that we study in the chapters to follow are particularly interrelated, and often we discuss the lack of efficiency in one of these areas by invoking imperfections in another. The sort of reasoning will be new to some of you because you've been brought up in a steady diet of perfect competition, and only recently has this focus started to change, at least in textbooks. This short chapter serves as an introduction to the sort of world we are going to enter by providing an overview and by putting forward several examples that will fix perspectives. From the viewpoint of development economics, missing or imperfect markets represent a crucial step in our understanding of the economic problems of developing countries. They also lie to the heart of institutions, informal institutions, which are reactions to the market loopholes that cannot be filled without because of legal, informational, or incentive constraints. So, the examples that it's talking about, let us dive into those examples to understand all this better. The basic ideas that drive our analysis are very simple: lack of information, the need to provide appropriate incentives, and limits to contractual enforcement create efficiency failures. The three things that we studied right here as well. So there's information, there's incentive, and there's limits to contracts. And these things create efficiency failures. So if information is lacking, and the need to provide appropriate incentives and limits to contractual enforcement, okay, creates efficiency failures. Often an unequal distribution of income or wealth excavates these failures. When there is unequal distribution of income, all of these things are even more embossed. We study these in concrete situations. Consider several examples. Information. Unobserved actions. Suppose that you're a landlord who is leasing out land to a tenant. You expect your tenant to put some minimal effort into the land. Ideally, write this into a contract Our agreement requires that you work 10 hours a day with a break for meals. Okay, so you are leasing out a land to a tenant who's going to probably, grow there, whatever he's trying to grow, a flow or whatever. So you get into this arrangement or agreement where you make a contract and you ask him that you need to work on this land for 10 hours, okay, and break meals. However, such clauses are useless if, say, you are an absentee landlord who lives in this city and you cannot observe what the tenant is up to. So, if these are unobserved actions, all right, so you can't observe what the tenant is doing, right? You can't just exactly like in the case of insurance companies or home loans, etc. So they can't always be 24/7 looking into the fact that you're taking care of yourself or your house or whatever. Yeah. However, you could respond, I don't need to see how hard the tenant is working. I can just tell by looking at what he produces. But well, you can tell according to the produce that he's making out that land. Because say he works 10 hours a day for a month, you know an approximate amount of product that he could be growing or he ought to grow. Okay, so if it is a little bit deterring from that, then it's still understandable because you're not there to observe everything. But you can still, if it's a margin which is large, if it's by a large margin that that person has failed, say he had to grow 10 bags of, I don't know, wheat or something, but he has grown only five, then you know that there is some asymmetry. Whereas if he's grown say nine, then you have to, or you need to give the benefit of doubt because you were not there to observe exactly what was happening. Okay. Can you? Many factors determine output. The hardworking or lazy tenant, the rains, crop damage caused by pets, and so on. How can you be sure that low output is due to laziness rather than bad luck? So, in such a case, also a fact which comes into the picture is that you can't know about crop damage or pests or whatever, and which is not, which does not imply that the tenant was lazy, rather all of these things were unavoidable. How can you be sure that low output is due to laziness rather than bad luck? Thus, your contracts must be suitably limited. The incomplete market here stems from lack of observability because you cannot observe each and everything. As we will see, this has deep implications for the efficiency of landlord tenant relationships. The problems of unobserved actions lead to what is known as moral hazard. Now, the thing that comes into play is moral hazard. The danger that an agent will take actions in his interest and not in yours. So, what is moral hazard? It is basically the danger that an agent will take actions in his interest and not yours. So, you've given him your land to plow, and he might not plow it with the hard work that is required because he might just want to say lazy around, or he might just go out and work on another field as well while working at yours. Okay, so you think that he is giving full time to your field, whereas he's actually working two fields. That is moral hazard. Moving on to unobserved types. A NGO is lending to poor farmers. Although the NGO is not necessarily driven by profits, it would like to cover its costs, right, of lending. The problem is that some borrowers are intrinsically bad risks, but the NGO cannot spot this by looking at a borrower's face, and moreover, past records are misleading or non existent. What can the NGO do? Two possibilities are to charge an interest rate premium on the loan or to require suitable collateral. So you either give him more interest rate than is already existent in the market, or you ask him for suitable collateral. However, high interest rate will discourage good borrowers from the NGO. say you're charging a very high interest rate, that will definitely take into account or create for your speculation that this borrower is not might not be right, but also it would discourage the good borrowers, correct? Whom the NGO would like to reach and will not prevent bad borrowers from defaulting. And the bad borrowers uh, will not be prevented from defaulting. Indeed, it will further encourage them to do so, right? So, because farmers are poor, they may not be able to put up collateral. And the second thing is that if you're an NGO, you want to lend basically to the people who are not able to easily fend for themselves, who say do not have a collateral. That's why they're reaching out to an NGO, not to say a bank, right? But you are putting up a collateral on them, but they're so poor that they don't even have collateral. So what are you're discouraging them as well? An innovative solution is to lend to groups of 4 or 5 borrowers and cut off loans if any one member of the group defaults. Okay, so if so, you lending together to 4 or 5 borrowers and then you cut off the loan entirely if any even one of the member defaults. If farmers know more than the NGO does regarding the characteristics of the fellow farmers, they will self-select the safe groups. So what you're actually doing is asking the people to choose for themselves. Whereas if 4 of them are good people, they will not let a fifth person who's a bad person or a bad borrower who they perhaps know would not be able to return back to the NGO, and thus it will be a safe option both for the 4 farmers as well as for the NGO. Thus, group lending is a response to incomplete information. So if you have incomplete information about the people or the borrowers, then what you do is you group lend. Incentives conflict with insurance. The moral hazard problem outlined in the first example stems from limited information. Thus, contracts have to be designed to provide appropriate incentives. For instance, if a large employer hires labor and is unable to monitor the labor's activities, he might offer a contract that stipulates the payment of an attractive wage unless evidence accumulates regarding shrinking. Then the laborer will be fired. Note that evidence may be indirect and sometimes inaccurate. For example, the crop may be poor because of insufficient rain, not the laborer's failure to apply adequate fertilizer. It follows that contracts based on indirect evidence create uncertainty for economic agents who dislike uncertainty, and the lack of insurance constitutes an inefficiency. However, it is an inefficiency that the employer can do little about. You cannot do anything about, not training. To provide appropriate incentives, he must pay different amounts for success and failure, even though these concepts may be loosely linked to the efforts of the laborer. Well, success and failure is loosely linked to the efforts of the laborer because even if there was failure, we're assuming that he did do hard work, whereas it did not train, so it was not his problem or it was not his fault, rather, right? So, so you basically play on incentives, appropriate incentives. Okay. Evidential. So he is going to give an attractive wage unless there's an evidence that he's not performed nicely, the laborer. Okay. Incentives, short term contracts. The abhorrent tradition of slavery had a pervasively beneficial byproduct. Because employers could own slaves, they treated slaves as a capital good and invested in them, particularly in the spheres of nutrition and health. Contrast this with more enlightened world in which no employer has unlimited rights over his employees. Okay, in this case, they do have unlimited rights. In consequence, employers may have little incentive to invest in their employees. Okay, so they do not have unlimited rights, so they don't care howsoever the slaves are. They just want their work done. In consequence, Employers may have little incentive to invest in the employees in the form of adequate nutrition or on the job training. In poor societies, this can lead to a state of affairs in which an entire population of workers is undernourished because of low wages, and this in turn feeds back and on overall economic efficiency. In the end, so if they are not well nourished, I mean, if employers do not have unlimited rights on them, they would not care about the nutrition level or on the job training. And this would eventually lead to overall economic efficiency falling because they won't be able to make the produce that is required to help the economy grow. In the end, both employers and employee may be worse off. Yeah. It's very conventional, but yes. Enforcement. Next, we're talking about is enforcement. We've talked about incentives in two examples. We've talked about information, and I want you to keep in mind what we were studying. We were studying information, which was the first thing. I am sorry. This was the first. Appropriate incentives was the second, and now we're on the third, which is talking about efficiency or enforcement. Limited liability. Suppose that you're a money lender advancing a loan. You know that the loan will be used in an investment project that is risky. If it pays off, you will get your money back with interest. But if it does not, you will get nothing. Why nothing? Well, one reason may be that the borrower is poor and cannot pay out of past wealth because he has little or none. This very natural limited liability constraint can have sharp implications. Borrowers who are thus insulated may want to overinvest in risky projects. Okay, insulated, you already have a backing. So you would want to overinvest in risky projects because you know that there is insulation. Because in effect, you bear the downside risk, not them. So insulated here basically means that when you are giving out the money to particular people, so they have the money and they will overinvest in risky projects because there's limited liability, right? Because you will get nothing if the project does not work out, but if it does, you will get your money back with interest. So they don't actually care because if it works out, it's good for you and them. But if it doesn't, it's only bad for you and not for them because your money was there. One outcome may be credit rationing, in which the standard competitive assumption that borrowers can get all the loans they want at an ongoing rate of interest is violated. You do not raise loan levels because you're afraid of losing more if the project collapses, yet you're afraid to raise interest rates because this way you attract the more risky borrowers. Okay, that's why what you could do is credit rationing. Breaking agreements. The group of poor farmers may seek to insure one another against fluctuations in their own output. Farmer A may transfer money to farmer B when farmer A has good harvest and B does not. If both A and B honor the scheme, then both would be better off. Okay, so if say A has not had a good year this time, so he'll just borrow from B, okay, and B is just going to give it to him because this is an uncertain criteria that we don't know whose crop is going to be bad, okay. Whereas in this case, it's yeah, the other way around. But how is this mutual insurance scheme to be enforced when it comes B's turn to pay after having enjoyed, say, a couple of years of transfers and he does not? courts of law to enforce such agreements may be non-existent or incapable of suitable verification. Informal insurance must then rest on the implicit nexus of social agreement because courts cannot enforce this because it was not legally uh, made proof of. Okay, informal insurance must then rest on the implicit nexus of social agreement, coupled with the sanction and disciplining of deviators from the agreement. Central to such a nexus is the flow of information. It must be possible to make others reliably aware of one person's misbehavior. Much of what we see in this setting becomes entirely explicable once we understand that informal institutions are spontaneous creatures of the need to account for informational failures or the need to provide adequate incentives to economic agents. So whatever we studied or in all of these settings, it is explicable or understandable or explainable once we understand that informal institutions are spontaneous features. These are all informal institutions. Okay, these are not legalized, all of these things, and they're spontaneous features of the need to account for informational failures or the need to provide adequate incentives to economic agents or the need to make sure that contracts cannot be enforced by law are somehow enforced by substitute aid arrangements. To study The study of informal institutions will help us resolve or at least understand some apparently puzzling observations. For instance, why do landlords often ask for a share of their tenant's crop instead of a fixed payment? Okay, this is what we're going to study in land, which would save them the task of verifying and measuring output. So they're talking about sharecropping against fixed rent. Okay, why might an indebted tenant not be forced to give up his land to a landlord to whom he owes money? Okay, this we might study in labor. Why do some money lenders advance loans at low, even zero rates of interest credit? Why are some laborers given different contractual package with different values, perhaps insurance? To whet your appetite a bit more, here's an interesting example of an informal institution from West Africa. You might want to give it a read if you want to.